Mathematically, a covered call and a cash-secured put have the exact same profit and loss graph, yet most traders handle them completely differently. Many traders view covered calls and cash-secured puts as opposites. One is for stock owners, the other is for cash holders looking to enter the market. However, these two strategies are synthetically equivalent. If you align the strike prices and expiration dates, they behave identically. Let's prove this with the risk profile. Both strategies cap your maximum profit at the premium received plus the strike width, and both carry full downside risk if the stock drops to zero. This relationship is defined by put-call parity. It states that a call minus a put equals the stock price minus the strike price, plus interest/dividends. Since the risk profile is the same, the choice between them isn't about market direction. It comes down to logistics, dividends, and tax efficiency. First, let's look at capital efficiency. A cash-secured put requires cash collateral, while a covered call requires owning the shares. If you have a margin account, the put often uses less buying power than holding the stock directly. This frees up capital for other trades or interest-bearing cash. Next is the dividend factor. This is the most overlooked difference. Only the covered call owner collects the dividend payout. However, options markets are efficient. Put options usually trade at a slightly higher premium on dividend stocks to compensate for the missed dividend. So, when do you actually use which? We typically organize this using the will strategy framework. Use the cash-secured put when you have cash and want to enter a stock at a discount. You get paid to wait for your price. Use the covered call when you already own the stock and want to generate income or exit at a target profit price. The psychological difference in assignment is critical. With a covered call, assignment means selling your stock. With a put, it means buying stock. Taxation is the final major differentiator. If you've held a stock for a long time, selling a covered call requires care to avoid resetting your holding period. In-the-money calls can pause your holding period for tax purposes. Cash-secured puts are almost always taxed as short-term capital gains. Let's consolidate this into a final decision matrix. Ask yourself, do I own the stock? And what is my view on the market? If you are extremely bullish, neither strategy is ideal because both cap your upside. These are neutral to moderately bullish strategies. Also consider skew. Sometimes puts trade much richer than calls due to market fear. In that case, the synthetic put might offer slightly better yield. Remember, the risk is the same, holding the bag if the stock crashes. Don't sell puts or covered calls on stocks you wouldn't mind owning for years. Stop treating them as different risks. Use the put to enter and the call to exit. That is the essence of systematic income trading. Master the wheel strategy logic in this playlist.